So now let us start with the chapter of capital gains. So as far as the chapter of capital gains is concerned, this is one of the niche areas of income tax, which in practice will be very, very useful, because most of the opinions whichever is being given, it will be either in the area of capital gains. So basically it will be around the structuring area, which will mainly involve capital gains. Right. So as far as capital gains is concerned, at the intermediate level, we'll be discussing more about basics and sale of capital gains which is arising on sale of shares, or capital gains which is arising from sale of land or building, as the case may be, or some the depreciable asset area. So that's it. But in the final, you'll be learning more about capital gains on sale of a business. How will that arise? So all those things we'll discuss in final. So that is a very interesting area. But this is the base of the capital gain. So this is very, very important. So that if you're just going to choose income tax as your career, your major areas of focus will either be capital gains or PGB. Right. So first, in respect of capital gains. So this is the overview of the chapter. Section 45 will speak about section 45 is the charging section. Section 46 will speak about capital gains on liquidation of companies. 46A will speak about capital gains on buyback of shares. 47 transactions not regarded as transfer. 47A withdrawal of exemption in certain cases. Section 48 computation of capital gains. 49 cost of acquisition. 50 and 50A capital gains for depreciable asset. 50B slum sale. 50C full value of consideration, which will deal with stamp duty value. 51 will speak about forfeiture of advance money. 54 to 54F will speak about exemptions to capital gains. The better term should be deductions to capital gains. Yeah, I'm aware, but generally it is used in practice. So that is it. That's why we are using the term exemptions. But the actual, the actual meaning of those sections would be, it is better called deductions rather than exemptions, because exemption means it should not be included in the income at all. So basically whatever is given in section 10, it will not be included in income at all. That is only is known as exemptions. Whatever, if you're just going to include something in income and after that you are going to withdraw it, that is known as deduction. So basically 50 to 54 to 54H, it is better called deductions, right? Section 55 will speak about definitions and 55A will speak about reference to valuation officer. So one important aspect of the chapter of capital gains is, capital gains is the only head of income wherein you will be taxing the capital receipts. And until or unless a specific charge is created, capital receipts cannot be charged to income tax. Right? So if you have to charge a capital receipt to tax, that can be only under the head of capital gains. Right? So if a capital receipt is not taxable under the head capital gain, it cannot be taxed under any other head of income for that matter. If you have to tax a capital receipt, that can be only under the head capital gains. If not, there should be a specific charge under any other section. Okay, well. So now let us look into the charging section, section 45. As far as section 45 is concerned, it reads as follows. Any profit or gain arising from transfer of a capital asset effected in the previous year shall, save as otherwise provided in sections 54 to 54H, be chargeable to tax under the head capital gains in the year in which the transfer took place. Right. So let us learn the words one by one. The term profit or gain is not defined in the Act, but in general sense, it will include all the gains and losses also. Just because here the words used are profits or gains, that does not mean under the head capital gain you cannot get a loss. Right? The word profit will also include negative profit, which is nothing but loss. Right? Next is arising from transfer. The term transfer is defined under section 2 clause 47. Then of a capital asset, this capital asset is defined into clause 14. Effected in the previous year. Previous year is also defined. So you basically know what a previous year means. It is the financial year. It is defined in section 3. Shall save as otherwise as provided in 54 to 54H. Basically the deductions. shall be chargeable to tax under the head capital gains in the year in which the transfer took place. Right. So here you do not have the method of accounting, that is either accrual basis of accounting or cash basis of accounting. Nothing, none of those things are there. So in whichever year the transfer is taking place, in that year the income is chargeable to tax. Under the head capital gains, generally capital gains arises at a single point in time. Okay, so there are three major conditions which is to be satisfied for an income to be charged. First one is there should be profits or gains, right? Next, the transaction must be regarded as transfer, because if you just see here, without transfer you cannot, arising from a transfer. So whatever transaction is being effected, that should be a transfer. And the third aspect is the asset must be a capital asset. If the asset transferred is not a capital asset, that cannot be chargeable to tax, right? So first let us understand each term specifically. First let us learn about capital asset, which is defined in 2 clause 14. As per 2 clause 14, capital asset means property of any kind held by an assessee, whether or not connected with his business or profession, right? So whatever is being held by you as a property is a capital asset. Second point, generally at the intermediate level, it is not required. So any securities which is held by a foreign institutional investor, FIIs, is also a capital asset, right? So the term capital asset does not include the following. First, it will not include stock and trade. Right? So stock and trade is not included in the meaning of the term capital asset. So basically, let me just give you an idea. So whatever is the property, whatever property is being held by you is a capital asset. These are the exclusions from such capital asset. There are two major exclusions. One is stock and trade and the other one is personal effect, right? So stock in trade, whatever is stock in trade, basically if you're just trading in the business of aeroplane, the aeroplane is your stock in trade. If you are dealing in chairs, chair is your stock in trade. If you are dealing with land and building, so basically if you are a real estate broker, or if you are a real estate, if you are into the business of real estate, then land and building is your stock in trade. So whatever income is arising from sale of a stock in trade, that will not be taxable under the head capital gains because it is not a capital asset. That is first point. Second is personal effects is not to be included in the definition of capital asset. What do you mean by personal effect? It is to say movable property held for personal use. So whatever is being held for personal use, that is not a capital asset. But this excludes, personal effects excludes jewelry. So basically, if you just see here, first we saw the definition of capital asset. There are two exclusions. One on the stock in trade, another on the personal effect. And the personal effect is excluded. So which basically means all of these are capital assets only. Okay. So capital asset la two exclusion, one is stock and trade, one is personal effect. And the personal effect again there is exclusions. So அது என்னென்ன exclusions, அது வந்து அப்ப அதனோட மீனிங் என்னன்னா minus of minus plus ன்ற மாதிரி தான். Exclusionோட exclusion is nothing but inclusion in the definition. Okay. So it's jewelry, archaeological collections, drawings, paintings, sculptures, any work of art. So all of these are capital asset. In the இதே மாதிரி ஒரு similar list, it will be available in even in 56 to 10 for the purposes of gift. Okay. So அதுக்கப்புறமா capital gainsல இருக்க third exclusion வந்து agricultural land which is situated in India. Right. So what do you mean by agricultural land? So there are two conditions. It is in any area which is comprised within the jurisdiction of a municipality or a cantonment board which has a population of not less than 10,000. So basically assume for example, இப்போ சென்னையில வந்து ஒரு heart of the cityல வந்து I'm just planting 10 plantain trees, வாழை மரம் வச்சுட்டு அதுதான் வந்து it is an agricultural land அப்படின்னு சொல்ல முடியாது. Agricultural land should be rural. Only rural agricultural land is eligible for capital asset exemption. Other than urban agricultural land, capital gains arising from transfer from urban agricultural land is taxable. Whatever is arising only from a rural agricultural land is not exempted. So a rural agricultural land na enna அப்படின்னா, so it should not be within the jurisdiction of a municipality, municipal corporation, notified area committee, town area committee, town committee, or by whatever name called. So basically if it is within a municipality, So இப்போ Chennai is a municipality, Kanchipuram is a municipality, right? So அதெல்லாம் அந்த இடத்துலலாம் வந்து if you are just going to have it within its limits, it is known as urban agricultural land. So that is not eligible for exemption. Next, so this is a second condition. So if it is not within the municipal limits, but however, if it is not more than 2 kilometers from the local limits of a municipality or a cantonment board whose population does not exceed 1 lakh. So municipality or cantonment board order population, if it is not going to exceed 1 lakh and the land is situated within 2 kilometers, abdina, it is an urban agricultural land. So if it is situated within, if assume for example, I'll just put it this way. White screen. Here is the white screen. White screen. White screen. No. Yeah. Just a minute. I'm just loading the white screen. So if assume for example, this is a municipality. Is the correct screen visible? So this is the limits of a municipality. Okay, ma'am. So you are having, this is your land. So இப்போ இந்த land வந்து rural agriculture land இல்ல urban agriculture land நம்ம கண்டுபிடிக்கணும், right? So for that what you should do is you should measure the distance aerially between this area and this area. So இப்போ இது வந்து if it is within 2 kilometers அப்படின்னா இந்த முனிசிபாலிட்டியோடைய பாப்புலேஷன் என்னன்றதை நம்ம பார்க்கணும். If it is not exceeding, if it is less than 1 lakh அப்படின்னா, if it is less than 1 lakh and this distance is less than 2 kilometers, up to 2 kilometers, okay va, up to 2 kilometers இந்த ஏரியாக்குள்ள இருந்துச்சு and then இந்த முனிசிபாலிட்டியோடைய population less than 1 lakh இருந்துச்சுன்னா this land is a rural agricultural land. அப்படி இல்லைன்னா, so இப்போ assume for example இதே distance வந்து assume there is some other thing, இது வந்து 6 kilometers, இங்க is your agricultural land. So இப்போ இங்க வருது அப்படின்னா for this to be treated as urban agriculture, what to say, rural agriculture land, இங்க population limit will become 10 lakhs. Okay, more than 1 lakh but less than 10 lakhs இருந்துச்சுன்னா till 6 kilometers whatever is the land, it is to be treated as rural agricultural land. Okay, so next one, if it is going to be not more than 8 kilometers, not more than 8 kilometers, and in the population if it is going to be more than 10 lakhs, you have the till 8 kilometers. So till 8 kilometers whatever land is available, that is to be treated as rural agricultural land. Okay va, this is clear? Am I clear? Am I making sense? Hello? Yeah.
I saw.
Okay. So in any area which is measured aerially, not being more than 2 kilometers from the local limits of any municipality or contaminant board referred to in item A, and which has a population of not more than 10,000, population of more than 10,000 but not exceeding 1 lakh. So 10,000 to 1 lakh, 1 lakhs to 10 lakhs, more than 10 lakhs. So if it is to be 10,000 to 1 lakh, what will happen is up to 2 kilometers it will be treated as rural, and then இதுக்கு 6 kilometers if till 2 kilometers it will be treated as urban. Next till 6 kilometers it will be treated as urban. Next till 8 kilometers it will be treated as urban. அதுக்கப்புறமா இருக்கிறது rural. Okay, so the population means population according to the latest census which has been published. So இப்போதைக்கு நமக்கு recent daysல ரொம்ப நாள் எடுத்து census எடுத்து, right? So next is what is the meaning of the term transfer. As far as the term transfer is concerned, as per section 2 clause 47, in relation to a capital asset, it will include sale, exchange, relinquishment of an asset, extinguishments of any rights therein, compulsory acquisition by law, in case where the asset is converted by owner into stock and trade, that is conversion of a capital asset into stock and trade. Next, maturity or redemption of a zero coupon bond, and any transaction which is involving the allowing of possession of a immovable property to be taken or retained as per section 53A. So part performance of a contract, if you are just going to give the possession alone to the other person, in such case that is known as part performance. Then as per transfer of properties act, once the possession is given, it will be treated as transfer as per 247. Right. So sixth point, it is not a great point. I'm not just discussing sixth point because that might not be tested here. Next is section 48. How should a capital gain be computed? So as far as section 48 is concerned, income chargeable under the head capital gain shall be computed by deducting from full value of consideration received or accruing as a result of transfer. So from full value of consideration, first you can deduct expenditure which is incurred wholly and exclusively in connection with such transfer. So full value of consideration minus expenditure incurred wholly and exclusively in connection with transfer, you will be getting net consideration. From that net consideration, you can deduct two things. One is cost of acquisition and the other one is cost of improvement. Okay, so however, if the asset is a long-term, as per section 48 proviso 2, if the asset is a long-term capital gain, if the gain is a long-term capital gain which is arising from a transfer of a long-term capital asset, instead of cost of acquisition and the cost of improvement, you should use indexed cost of acquisition and indexed cost of improvement. So for that, first we need to learn what do you mean by a long-term capital asset. Long-term capital gain is defined as per section 29B, which means capital gain which is arising from transfer of a long-term capital asset. A long-term capital asset long-term capital asset is a capital asset which is not a short-term capital. So this is one of the easy definitions. So we should just we should read what is short-term. So whatever is not short-term, it is to be treated as long-term, right? So if it is a security which is listed in a recognized stock exchange, if it is held for less than 10 months, 12 months, it is short-term capital asset. If it is held for more than 12 months, it is a long-term capital asset. In case of an immovable property being land or building or both, if it is held for 24 months or less, it is short-term. More than 24 months, it is long-term. In case of any other asset, if it is held for more than 36 months, basically which is 3 years, it is to be treated as till 3 years short-term, more than 3 years, it is long-term. Right. Next, what do you mean by indexation? So indexation is very simple. Instead of getting into all this, so what is your cost of acquisition into cost inflation index of year of sale divided by cost inflation index of year of purchase or 1/4/2001, whichever is earlier. 1/4/2001, whichever is earlier. So because now 2001 la தான் வந்து the new cost inflation index has been notified, right? So 2001 க்கு முன்னாடி இருந்தாலுமே that is to be treated as 2001 only. So whatever is your cost of acquisition, take that cost of acquisition, and year on year you will be notified the cost inflation index. What is the cost inflation index? So you just multiply it with that cost inflation index divided by cost inflation index of the year of purchase, or 1st April 2001, whichever is earlier. Same is the case for cost of improvement also. Cost of improvement into cost inflation index of year of sale divided by cost inflation index of year in which the improvement is made, or 2001, whichever is earlier, right? But in the case la வந்து 2001 or whichever is earlier ன்றதுக்கு மட்டும் ஒரே ஒரு பாயிண்ட் இருக்கும். What that means is, so if your property is purchased before 1st April 2001, you can substitute the fair market value as on 1st April 2001, because that is the cost inflation index, since it is only starting from 2001. So if your improvement is made before 1st April 2001, once you're substituting the fair market value, your cost of improvement will also be included in that fair market value determination as on 1st April 2001. So you have an option to either choose fair market value as on 1st April 2001, or you can choose cost of acquisition. But inge வந்து your cost inflation index maximum base, it will be only 100 கம்மியா போகாது. Okay, so in case of acquisition, cost of acquisition into cost inflation index for the year of transfer divided by year of purchase, or cost inflation index for the year of transfer divided by year of improvement. So this will be your format for computation of capital gains. Full value of consideration minus expenses in connection with transfer is going to give me net consideration. So from that I have to deduct cost of acquisition or index to cost of acquisition. Index to cost of acquisition in case of long term, index to cost of improvement in case of long term, cost of acquisition or cost of improvement is in case of short term. Gives me the answer. Next is determination of consideration in certain cases. So capital gains in case of a real estate transaction, section 50C. If the asset transferred is a land or building or both, what you should do is you should take the consideration and multiply it with 110%, right? So if after multiplying it with 110%, if your stamp duty valuation is higher, you should consider stamp duty valuation as the full value of consideration. This is only applicable for real estate transaction, means if the asset transferred is land or building or both, only in such case section 50C will be applicable. So if the asset transferred is land or building or both, and if your consideration into 110% is less than stamp duty valuation, then in such case your stamp duty valuation should be substituted for full value of consideration, right? Next point is, on which dates stamp duty valuation should I take? So if the date of agreement for sale and date of sale deed is different, then stamp duty values on the date of agreement shall be taken if two conditions are satisfied. One is, full or part of the consideration should be received on or before the date of agreement for sale. So basically how a transaction will happen is, first you will put for agreement for sale, agreement of sale, then you will just negotiate, then you will reach sale agreement. Generally first agreement for sale இருக்கும். So agreement for sale liye you will decide what will be the sale consideration. Okay va? So அதனால என்ன சொல்லிருக்காங்கன்னா, இப்போ agreement for sale நீ போட போறேன்னா, agreement for sale is different and sale agreement is different அப்படின்னா, so agreement for sale dateல இருக்கிற stamp duty value you can take. So this is assuming it in 22 and this is 23. So you can take the stamp duty value as on the agreement of sale if two conditions are satisfied. First condition is your full or part consideration should be received on that date, and such consideration should be received by account pay check or account pay draft or electronic clearing system. So இது ரெண்டு மட்டும் இது இருந்துச்சுன்னா போது, you can just take it up. So இதே மாதிரி section 50C is for capital gains. அதே corresponding section is there in case of PGPP also in section 43CA. So if the asset transferred is land or building or both, and consideration into 110% is less than stamp duty valuation, then stamp duty valuation is to be taken as full value of consideration, right? Next is deductions from capital gains. So as far as deductions from capital gains is concerned, these are some important sections, section 54, 54F and 54EC. So mostly these three will only be tested in examinations. Section 1037, 54B and 54D, maybe it could be tested only in MCQs. Or if at all a remote chance is there, they might test 54B. So 54D and 1037, Most of the cases it might not be tested, right? First is section 54. Section 54 is applicable only in case of an individual or HUF, and your asset transfer should be a residential house property, right? So if these two conditions are satisfied, you are eligible for deduction under section 54. So what you should buy is, you should buy one residential house property in India. However, in certain situations, you can buy two residential house properties. What is the certain situations? I'll just let you know. Next is within which time limit you have to buy the new asset. If you are going to purchase the new asset, you can do it within 1 year before the purchase, 1 year before the sale, or 2 years after the date of transfer of the residential house property. However, if you are just going to construct the new residential house property, it should be constructed within 3 years from the date of transfer, right? Next is section in section 54 itself, what is the amount of deduction? So your cost of the new residential house or capital gains, whichever is less, can be taken as deduction, right? So the new residential house property, one of the conditions which is to be satisfied is the new residential house property should not be transferred for the period of 3 years from the date of acquisition. What will happen if you are just going to sell it within 3 years from the date of acquisition? The cost of the new residential house property will be reduced from the amount exempt from section 54. So we'll just take an example. So in Y1 under 54, you claimed a deduction of 10 lakhs, okay, by purchasing a residential house property. In year 2, you are selling this house property which you have purchased. So what will happen for 20 lakhs? So sale consideration is 20 lakhs. So cost of acquisition, you have purchased it for 10 lakhs, right? So again, your cost of new residential house will be reduced by the amount which is exempt from under section 54F. Section 54F already number exemption claim 10 lakhs. So basically, your capital gains of the second property will be only 20 lakhs. Okay, wow. So this is the try பண்ணிருக்காங்க. If you are going to sell the new residential house property which is purchased within 3 years, in such case, whatever amount has been claimed as deduction, that is to be forgone, right? So இந்த two residential house properties சொல்லிட்டு நம்ம இங்க ஒரு கண்டிஷன் பார்த்தோம். அது எப்போ applicable அப்படின்னு பார்த்தோன்னா, if your capital gain is not going to exceed 2 crores, right? In such case, instead of one residential property, you can purchase two residential property, right? However, if once the option is exercised, then the assessee will not be allowed to exercise the option in the same or any other assessment year, which means for only one assessment year, you can claim this exemption from two residential house properties. மீதி எல்லா கேஸ்லயுமே ஒரே ஒரு residential house property மட்டும்தான். Next is section 54F. Section 54F is also applicable only for an individual or HUF. இங்கே capital asset transferred any capital asset other than a residential house. So if it is residential house, you will be having only 54. If it is any asset other than a residential house, you will be having 54F also. What is the eligible investment is one residential house property. Time limit for investment similar to section 54. If it is going to be purchased, it should be purchased 1 year before or 2 years after the date of transfer. If it is in case of construction, it should be constructed within 3 years from the date of transfer, right? So the exemption will work a bit different. You'll be having two situations. First one is if the cost of the new residential house is greater than the net consideration, then the entire capital gains can be claimed as deduction. If amount invested is less than the net consideration, amount invested into capital gains divided by net consideration is the amount which is to be exempted from capital gains, right? Here, a few more conditions are to be satisfied. First one is you should not own more than one residential house property on the date of transfer, right? Second one is the new house property should not be sold within a period of 3 years. Third point is the assessee should not purchase for a period of 2 years or construct for a period of 3 years any residential house property other than the house property for which exemption is claimed. So மொத்தம் 3 condition. First condition you should not have more than one house property on the date of transfer. Second, the new house property which you are purchasing is not to be sold for a period of 3 years. Third point is for a period of 2 years you should not purchase, and for a period of 3 years you should not construct any residential house property, right? So if you are just going to violate any of these conditions, right, so whatever amount has been exempted under section 54F in the year in which you made a transfer, that will be taxable in the year in which the assessee violates. So that is in relation to section 54F. Next is section 54EC. 54EC is again available for all the assessee. However, here the asset which is transferred should be either land or building or both. So what should you purchase for claiming a deduction under section 54 EC is you can purchase redeemable bonds or National Highways Authorities of India bonds, REC bonds, or PFC or IFRC bonds. So within when should you purchase? Within 6 months from the date of transfer, you are to purchase the the bonds. However, there is a limit of purchase. First one is what is the amount of deduction? Very simple. Cost of the new asset which is purchased or capital gains, whichever is less. But one condition which is to be satisfied here is wherever investment is being made in the specified asset, you should not invest an amount exceeding 50 lakh rupees. Okay, ma'am. Only up to 50 lakhs you can invest. More than 50 lakhs you cannot invest under section 54 EC. 54 EC bonds maximum 50 lakhs தான் உன்னால invest பண்ண முடியும். அதை தாண்டி you cannot invest, right? The next point is if it is acquired on or after 1st April 2018 for a period of 5 years you should not sell the new asset. If you are going to sell the new asset within a period of 5 years, whatever amount has been exempt under section 54 EC will be taxable in the year of violation. So first, till this, is it clear? So that was in relation to sale of a normal capital asset, which is a land or building or both. Next, இது வந்து special case, two special cases which we should discuss. One is capital gains on sale of a depreciable asset. Second one is capital gains on sale of shares. So first நம்ம என்ன பண்ணுவோம்னா first we'll discuss capital gains on sale of a depreciable asset, and we'll take a break and do certain problems, and then we'll go for capital gains on sale of shares, right? So as far as capital gains on sale, yeah, just give me a minute.